All right, we got all the kinks worked out, which means it's that time to bring in Tech Trader Sean. How are you this morning?
I'm good. Can you hear me?
Yeah, you're breaking up a little bit, so we'll have to work with what we got. But you had some interesting things to talk about offline in our little chat before we jumped on here today. But before we get into that, as always, I want to get your overall interpretation of where we are in the markets. We'll start with the Nasdaq in general.
Well, I'm content. I'm very content to ride longs, but it's a market where I would say, I milked it. I just milked it really good. So now I need, I guess, the fattest of the fat pitches to kind of add anything new or size anything up. We'll see what happens. I just put a note out, and maybe one of the things we could talk about today is the Fed, but I actually kind of think the Fed needed to reverse course because they were going full on, headlong into kind of almost a crazy, a crazy rate hiking cycle. One that didn't make sense. One where it appeared that they wanted to get rates to, I don't know, 350, 450%, 4.5%, in a world at zero bound. So the problem, how they kept doing that and gotten rates to 4%, well, maybe some savers who buy CDs would have been happy, but they pretty much would have assured that we would have gone into a sort of a serious recession, whereby then they would simply have to lower rates probably down to 0 or 1% to get us out of the recession. So it's a good thing that the Fed sort of saw the error of how stupid that was. Now, at the same time, I bring this up because are they getting too dovish now? I fully believe the Fed is going to hike rates. I don't think they're going to hike a lot of times this year, but I wouldn't be surprised at all if they do one or two. I think one should be what people think. It seems to me now most people don't think they're going to do any. In the latest Fed meeting, I think I put a note out something like the Fed let the doves fly. They really did. It's almost like they got way more dovish than they really need to be. So I don't know. We'll just see what happens. So the problem is, if you're trading on the Fed now, on what they said now, I would say you just have to be mindful of, were you trading on where the Fed was when they were still hiking rates, when it was pretty obvious that they were going to have to stop. So in other words, when they first made the turn, stocks are way lower, had way more upside, and have fulfilled nicely to the upside. So it's like anything else. Hey, you're gonna buy Zscaler right here, up $4 in the day, or you're gonna look for something else that's trading cheaper. Different people do different things. But again, I kind of think the best time to be proactive and increase longs, notably, was when the Fed was still threatening hikes, but looking like they were going to have to turn tail, which is exactly what they did. So now you kind of have the opposite playbook. Look, you want to get max bullish, mass aggressive, and kind of hope we have a 50% version of 1999 and hope stocks keep going up at ever more expensive levels. Or you have to start kind of at least thinking, well, the Fed might not be done. Stocks keep going up more. Maybe the Fed comes back into play. Maybe some of these recession fear stories aren't so great. Maybe the economy is kind of the same as it always is, and so if it heats up a little bit more, the Fed might start talking hikes again in 3 months. So the thing, you just have to be mindful of that. If you're making big bets on the latest Fed comments, I would say the latest ones have less relevance than the comments of 3 months, 4 months, 8 months ago. So you just have to kind of put all this in the mixer. But like I say, everything has a price, everything has a risk, everything has a reward. You just have to weigh all those risk reward benefits and things like that. So I'll kind of end there on the Fed and jump in with whatever you want. But like I say, just look, stocks were just way cheaper when the S&P was between 2350 and 2500, and that's just a simple marker. And that's when people didn't believe that the Fed was as dovish as they've become. So we'll have to see what happens. But I kind of think we're almost setting up Did the Fed just overshoot a little bit? The Fed overshot before. They overshot with their hawkishness, and then they turned tail. Are they at a point or close to a point where they overshot in dovishness? We'll see. I kind of think they are.
All right, well, let's pivot to Apple because they had their big event yesterday, and from what I can determine from your little write-up just now, you see some downside risk in Apple. Why do you think that?
Well, I don't, again, the downside, if the indices keep going up, if this is the echo of 99, Apple probably works higher. But I just don't know if that, are you going to make a ton of money, in Apple from here? I kind of liked it lower. It's been okay. You're still going to have multiple sluggish quarters. I mean, to me, the stock's basically just kind of feels like it's ahead of itself. You're going to have sluggish quarters. You aren't going to have 5G solution. I mean, arguably everything it just announced yesterday, I was literally writing out pieces and talking that Apple should have been doing those things in 2012 and 2013. And they just did them in 2019. So, new subscription, fine, that's pretty good. It's, I guess, better late than never. I don't think they're going to get a ton of traction on it. Again, it's little incremental improvements to a huge machine, which is Apple. So they're not going to move the needle. Now, there were a lot of people who said the Apple Watch wasn't going to move the needle. I wasn't one of them. I mean, that's a product I liked. I liked early on. I think it's proving to move the needle. It's selling in the billions of dollars with a growing platform, adds to the ecosystem. Now, I've historically been pretty good at kind of knowing what things are going to move the needle. I guess my biggest criticism of Apple remains the same thing. They haven't done any M&A. They've bought a lot of stock back, very high prices. I think the M&A is a better use of those funds. The other issue is that there's certain things they used to own. They owned digital music for a while. And it took them a long time to come out with a compelling, streaming radio product. In the meantime, they pretty much lost the market. So I don't think they're going to win that market back. Spotify, Pandora, now Sirius owns Pandora. There's other radio platforms. So the market, the streaming music market, largely Apple has ceded it to other players. And I think they're going to be hard-pressed to win much share back. I think Spotify is a far. I mean, put it this way: let's say I was inclined to buy Apple, I would simply look at Apple versus Spotify, and it would take me about 8 seconds to decide that I think Spotify is a better long. It's that, or I would line up Apple versus Baidu, and the same thing. It would take me about 3 seconds to determine Baidu is a better long. So if we already had an FTC decision and we knew whatever that outcome was. But let's assume it's not extremely penal. Same thing. I'd vastly prefer Qualcomm to Apple. So there's lots of names I just prefer. I don't think I'd short Apple. I don't think I've said. There's a couple times I danced with shorting it at much higher levels, although it's kind of back. I mean, here's the interesting thing. I've hardly been watching Apple. Not saying I don't look at it. Look at the charts once in a while. I literally was shocked the other day. I don't think I'd looked at it for about a day and a half, and I was shocked the other day when I saw it like 195 plus. Because I think a day and a half prior, it was like 182 or something, and so the typical run it up into an event. Again, I don't think this event's a big deal. Hey, the time to buy Apple now. We'll see what the price is. I'd still stay 2-3 quarters in front of their 5G phone launch, because then they'll have a hell of a refresh cycle for iPhones. I think that'll be a better time. I mean, if you're prepared to hold Apple until spring of 2020 or summer of 2020 and hope it doesn't have another big material lowering of expectations and sort of down cycle, then it's probably fine. It's probably fine. You can probably write a lot of call premium on it. So I'm not an Apple hater. I just think there's a lot of things that are set up better.
All right. Well, one of the things that you thought set up really well was the ticker BE, Bloom Energy. So you got out of your comfort zone a little bit. This one, let's see, in the energy space, and let's see, you got in around the $11 area, right?
again, you look at these things. Bloom has had some incredible reports. And, huge growth rates. Now you get a little bit of an accounting change, but I don't know, people don't seem to mind the accounting changes in the software space, boost the numbers. So I don't know why they'd let that bother them with Bloom. Anyway, you have a company delivering some really, really exciting kind of growth prospects. And the other thing I've kind of had in the back of my mind, too, are, alt energy plays. So whether it's battery tech, whether it's energy production, whether it's solar, whatever. At some point, and I put this in my notes that I posted today. At some point, if the market just keeps lifting, and we go to kind of an environment that even gets more overvalued. Well, what eventually happens is the stocks that are cheap, they're not just overvalued, they're not just less overvalued, they're just flat out cheap. But they've been ignored or have been hated, or again, everything has its time and place. But the stocks that tend to do best in a late cycle are stocks that haven't participated and need to catch up. And the one area that did very, very well in mid to late 2000 and early 14 was energy and solar in particular. I want to say I think SunPower went from like 4 to 40 in a couple years. CSIQ was the name I played. Jinko was the name I played. Most of these I don't really even look at anymore. SunEdison went from probably 2 to 30 before they went bankrupt. But hey, if you're on the right side of SunEdison, from 5, I think that was I don't know, 5 to 15 at least. So the bottom line is there's always names to participate. But that was a really good example of. There was a huge catch-up phase, and that was kind of a similar environment. You had the Fed basically went from kind of thinking about tightening to going into, I think that was the third QE. I think that was the QE to infinity at that time, and that was a year I was actually really bullish on too, just leading into that year. So in late 2012, everybody was super negative. Sounds familiar, just like last year. I got super bullish into late in the year, did very well, then kind of had to migrate. Now, the only difference was you had a former leader called Apple got demolished. So that was one of the few only real popular names that I worked real hard in 2013. Most of 2013, I was playing unloved catch-up trades and did exceedingly well. And I think it's kind of a similar setup now. And again, hey, maybe Zscaler keeps going up. Maybe some of my shorts keep going higher. But I think there's going to be certain names that have like explosive potential. I mean, BE, just look at the chart. And again, I don't know if I have. I do like this for investment purposes because I think it's very cheap. But I actually think I've been watching this since the IPO. They IPO'd around 18. They traded a little bit above it. They somehow got to like the mid-30s. Again, I'm not. I was. I don't think I even posted anything on BE back then. Maybe around the IPO, I might have had one comment. And over time, they basically cut it by 2/3. It's gone from the 30s to the 9 to 11 range, and I can't really find the report they've missed. I went back and looked at every single report. They all look good. They all look like beats. Some of the beats were huge beats. And the stock has popped a number of times, but I think, this was a combination of an IPO lockup. I think you had some big venture capital selling on it. And then they finally put in a good bounce and then retraced a big chunk of the good bounce. And that's what I find really attractive, actually. So there's a trend line break, stock pop. There's another trend line break setting up. So this is probably more of a technical play for me right now. But it's more of a long term. I mean, I think that what was the prior high? The recent high was 17 was. I'm sort of marking that 1540 level. The stock actually traded at that level almost 4 times. What it hit 1522. Then had that crazy weird spike that it didn't hold. But then it retested sort of 15ish, and then it retested 15 something again. So, I mean, I don't know. I mean, 11, 12-ish to 15 plus, that's a pretty good return. And if it happens to break above, I think really that 15, that mid 15 area is probably one of the more critical areas, because if it breaks above that, I think it can kind of retake, prior highs. I'm still kind of working on a valuation model. I mean, I'll be honest, I don't really want to tell people what I can value this to, because it almost seems crazy, because it's way higher than what the stock is. But let's just say this, 18 to 20 is not, I mean, I can put a valuation case at 18 to 20, and it's cheap. So, and like I said, though, there's three reasons. There's other reasons I like that. I kind of mentioned them. One, we should get some sort of a lift in energy. And usually they coincide. Usually you get oil continues to go higher. Again, setup for oil is really good too. That's a whole nother discussion. But again, super easy Fed environment's usually really good for commodities and commodity price increases. And oil's the leading one of those. So you add it all up. Usually the alt energy space sort of lags, and then you get a big move in oil. And then all of a sudden everybody wakes up and go, oh man, wait a second, oil's going up. Maybe I should look at these alt energy stocks. Now they probably move 30 or 40% already, but that's okay, because usually when they decide to go, they go at least mini multi-bagger, like 2-3 bagger, sometimes way more. So yeah, I mean, I'm looking at that stuff. I think that's pretty compelling. I think that's a good place to be. And most importantly, I think the risk there is a lot lower than most of the current favorites right now.
All right, let's circle back on one of your other names that you like a lot, and that's Twitter. You think this one's on the verge of breaking out?
I really do. I think Twitter has marked a lot of time. We've talked about the fundamentals of Twitter a lot, so I don't know if we really need to spend a lot of time. I mean, fundamentally, I think the stock has gone from almost gotten way too cheap again. It's not quite as cheap as it was at 16 to 18 a couple of years ago, but it's kind of similar, because they've grown the revenue base a lot, and the stock has peeled a lot from that $45 high mark. So the fundamentals are right. Again, there's a lot of things happening that Twitter's actually benefiting from, and they get no credit. AI, they're a massive AI feedstock, yet they never get included in sort of in any AI investment lists. I mean, look at the Apple News. I mean, to the degree people are excited about an Apple News subscription service, okay, so, hey, that might be $1 billion a year incremental business for them or something like that. I mean, if Twitter did it, that'd be a huge needle mover for Twitter. And Twitter there is some thought that Twitter could charge for TweetDeck, could charge for a TweetDeck Pro, could charge for, again, a financial news subscription bundle or various subscription bundle type products. I think Twitter should onboard way differently. We've talked about that. I think if they onboarded via exactly how Apple News or Zeit or Flipboard onboards, with an interest-based, hey, what are your favorite interests? What are your favorite publications? What do you currently subscribe to, or what would you be interested in subscribing to, et cetera, et cetera. I think Twitter onboarding process would be, I literally think you'd see Twitter add 150 to 200 million users if they onboarded differently. Or if TweetDeck was an onboarding option, because I think people who use TweetDeck as their Twitter front end have a completely different experience with Twitter. So anyway, you just line it all up. Just that's one thing they could do. That's one revenue stream that they could turn on that, well, it might not be nearly as big of a revenue stream for Apple. It would move the Twitter needle a lot more than it would move the needle for Apple. And that's just one tiny little idea. But the most important thing is that you get a trend line break on it. So right now, you get a trend line break. Twitter also did its typical thing. It has this spike to 34. What happened? The people who were buying 33.80 to 34 whatever likely got stopped the next day. So the algos did their favorite kind of stop type run on it, which you almost always see with this name. Those people got scrubbed out. Now it's free to run. Again, I think it's going to break out. The only thing I don't know, does it go to 40? Does it go to 38? I mean, I suspect at some point it's going to easily fill the gap. So the gap doesn't even start till about 37.5 to 38. The gap doesn't fill till like roughly 42. I don't know. Maybe that's probably. I mean, it's got to get to 38 before it goes to 42. So, I'm pretty much playing it for a move to 38, see what happens, maybe get some resistance, then a move to 42. This is definitely a stock that should retake highs. I mean, if people think the MongoDB is worth 150, and they honestly think it's worth that, then what's Twitter worth? I mean, Twitter, I mean, Twitter's worth 50 or 60 if MongoDB is worth 150. Now, maybe the MongoDB isn't actually worth this, not going to stay here very long, so therefore, it goes to some lower level, so then Twitter doesn't have to go up to meet it. But, you do this kind of relative value math, and it's exceedingly cheap versus kind of anything else. So I'm pretty comfortable in that. And like I said, just the setup's good. You don't see these long-term trend line breaks on Twitter very often. I'm trying to think. The last time we had one sort of this defined, I think you have to go back. It probably preceded the gap move when Twitter went from 23 to the low 30s. So I think that's the last time. I'm looking at a weekly chart right now, but that looks like it. It's been quite a while since you've had, a big trend line break like we have right now on Twitter. So this is a good one. When you have these trend line break setups on Twitter, it very often fulfills. By the way, the biggest and the best one I played was when the trend line break broke at, I don't know, it was about 1650. That was a massive trend line break. But that one was about 2 years old now.
All right, so first initial target you'd be looking at is 38. Next one would be 42.
Yeah. I mean, it doesn't mean it's going to stop there, but I think that's the trade. I think that's the near-term trade.
All right, now one more I want to highlight here before we get into Lyft, and your takeaway on that one is Criteo, CRTO. This one's gotten hit pretty hard over the last 3 sessions. Looks like it might have bounced off the 1850 area. Haven't heard you perk up as far as any interest. Why or why not?
Well, I'm looking at it. I mean, one thing I know this company, and when there's an actual algorithmic change, that has rocked these guys before. I would say maybe this time around they kind of know how to deal with it better, since they've dealt with the last 2 times this has happened. The stock's dropped quite a bit. I mean, to the tune of like 35% plus, maybe 50%. But the stock was cheaper this time around, so I don't know if it's going to hit it as hard. I don't know. Sometimes something like this stands out really good, really clear. I mean, there's a lot of stuff I like. I mean, I still like every single one of my 5G names, still like every single one of my fiber optic names, still like Twitter, still like Baidu. I could put a lot more money in Baidu. So I don't know. I think it's more of, I don't mind it here. But this is the first day. Well, I guess this is day 2 of a drop. But this is the first day where you've had a drop on downgrades, and the violence is really, really severe. I mean, maybe just give this one a 3-day roll and kind of see where it is. I do like that. I mean, here's the thing. Okay, so same kind of deal. I mean, if Criteo really should be trading here, where should TTD be trading? I don't know. So that's the other thing. I might, maybe I'll do something on TTD. So, but if Criteo, I think there's maybe an overreaction, but this is going to hurt their revenues. I mean, so they're going to have to deal with it. It's going to hurt their revenues. I don't know if it's going to be nearly as bad as sort of the bear case. I think they'll be able to respond quicker than they have before. Because again, I think this is at least like the 3rd or 4th time they've been hit with sort of the major Google algorithmic change, search change, things like that. So my guess is they've probably learned from those prior experiences, and they probably can respond and react faster. But that doesn't mean it's not going to crimp them. I mean, it's probably going to be pretty close to impossible for them to make their next quarter, or the quarter that this starts hitting them on. So we'll see. I mean, it's a decent name, but it's never really been. It's never really been one of my feature names. I do think there's a good operator, a lot of good value, good balance sheet value. I'm just going to watch it. We'll see what happens. It's definitely got my attention. I mean, I'd rather buy this name than a lot of other names, but like I say, would I rather buy IIVI than Criteo? Even though IIVI really hasn't pulled back, I might. And the reason I might is because, well, it has pulled back a little. And it's more of I have a very strong thesis on the stock. And again, it has had a decent little pullback, but the biggest thing I like about IAV, I don't think it's gone up nearly as much as it should have on the last 2 or 3 quarters, let alone how cheaply they're getting all the Finisar assets. So it's a stock that sets up for me better. You know, just like I say, I have a strong thesis. My price target quite a bit higher, and you know, again, it's not so much that it's had a big pullback to buy, but it's more that it just should be up a lot higher based on prior numbers.
I'm curious, why do you think that this company is so bad at not being able to adapt quicker? Maybe having some foresight of when these changes are going to take place, so that they're not blindsided.
I don't think there's any way they know. I mean, they don't work at Google. So,
okay, but if they're linked so closely to them, why can't they communicate better? Is Google that secretive?
Yes, they're definitely that secretive. I think 100% they're that secretive. First of all, I mean, it's not. That's a good question. It's not. So if you'd known all the Apple supplier disruption issues, meaning companies that got a big contract with Apple, then 2 years later lost it and got cut in half, 50% in kind of one day. It's basically the same kind of thing.
But this has happened more than once.
It has, but there's been Apple suppliers who've gotten hit more than once too. Again, they don't know. I mean, they deal with Apple, they plan for it, they do the best, they make the best products they can. But if Apple decides they're going to use a different company for a chip, the company that was the prior provider gets hammered. I think it's kind of the same thing. Years ago, we used to see this with Dell. So when Dell was sort of the king of PC making, there used to be companies that used to move huge on Dell contract wins, and then sure enough, especially if they were small, many times they just get, live by the sword, die by the sword. They would get hammered because they'd lose the Dell socket, and, they drop huge. But there have been companies literally put out of business by losing Apple supplier agreements that they previously had. Portal Player was one. That was a number of years ago. They weren't put out of business. They were bought. In fact, NVIDIA might have bought Portal Player. I'd have to go back and look. But somebody bought Portal Player on the cheap after they lost an Apple slot, which was a good slot for them. And again, there's been tons of examples of this. So again, I don't know. I don't know if they can really plan for it. You know what? We'll see. We'll see how fast they respond this time. We'll see how quick they are and how fast they recover. I actually do think they'll probably respond better and quicker this time. But here's the thing: all of a sudden, you just insert a huge unknown. Into the equation. You insert a huge unknown into the financials. We'll see. So given that, these kind of stocks aren't exactly trading great right now either. There's still, there's still such a chase going on. So sometimes it's better to ignore it, kind of let it play out. But I think the value's there. Here's the thing too. I've got a pretty good balance. I've got growers, I've got new growers, I've got leaders, I've got laggards, I've got, I own stuff along the spectrum of sort of, I don't own anything hyper expensive, but, I own some expensive growers, I own some mid-price growers, I own some cheap growers. I shade my weightings, especially now, at the end of the year, I was buying expensive stocks like Documentum and, other names like that that were sort of out on the curve of the more expensive growth names. At this point, I got plenty of stuff. I mean, I just bought BE. I think BE, even though it's not tech, I think BE at 11 to 12 is very similar to kind of Criteo here. CommScope I like a lot. I was buying that cheaper, but that's had a nice pullback. I've got FireEye that never does anything, but that's dirt cheap in the software space. So, I don't know. I don't know if I need another, another ultra cheap kind of distressed valuation play at the moment. We'll kind of see what happens. But like I say, sometimes these things kind of get crazy. 18s might be crazy. Crazy could be 14, 15. I'm more apt to kind of fire at something if I think it's crazy. I don't know if it's crazy yet because this is real legitimate bad news. You know, Dycom, which is a name I traded very well, kind of very nice gain on. You know, that's back to under 46. You know, something like that's kind of becoming pretty attractive again. So if, you know, if I have my eye on a few things I like, sometimes I'll just kind of save my money. And then the last thing is, and we're going to talk about this, I don't know how much a lot of stocks are going to move after Lyft starts trading. So until the Lyft IPO comes out, prices and trades a little bit, you know, we might, I mean, something like the Cresceo might get a lot cheaper after Lyft is trading. So, and again, we can talk about Lyft whenever you want to transition to it, but we'll see. I don't know. I don't know that it's crazy. I'd rather buy it crazy cheap. I don't know if it's crazy right here.
Okay.
I could be right. Hey, in two days from now, it could be 22. But, you know, I'm fine passing on things, too. I mean, there's lots of ideas I have that I think will work that I don't trade.
Okay, and I do want to transition into Lyft because you mentioned to me earlier that you thought this was a big key for the market. So let's talk about some of the implications upon that IPO.
Yeah, I think there's a ton of them. I don't, you know, this is a market not just of Lyft, but it's a market that Lyft is going to be the first out in Uber, Lyft, Pinterest. Pinterest is a deal I'm actually pretty interested in, assuming it's not a Akamai crazy overpriced, or I don't know, I'm trying to think of a similar crazily priced stock. I mean, Elastic is a stock I very much like. Well, I should say it's a company I very much like. I really like their growth trajectory. I like the durability of the growth. But it's never traded at a price that I could stomach. And now theoretically you say, well, you should have just bought it at 65 and made 20 points on it. Well, I could have, but, you know, I've been very happy with everything I bought traded this year. So, you know, and I've had plenty of names that have gone up just as much, if not a greater percent, as Elastic's roughly 20%, 20-point move. So, but that's a name I really like, and I'm kind of waiting. I'm waiting for an attractive entry point. I don't like Lyft nearly as much. In fact, I don't even know if I like Lyft, to be honest. I think the IPO is going to work. I think it's going to probably trade similarly to how Elastic is traded. I think though Lyft is the first out of the gate of some potentially very large companies. Pinterest is going to be a pretty big deal. I haven't seen what their most they got to be at least a valuation of at least 15 billion plus. Again, Uber, who knows what that's going to come out. But you know, we've seen things like this before. To me, this environment feels a lot like spring of 2014. So the then cloud stars of that era were now Workday, Splunk, and a few others, Palo Alto Networks, a few more, FireEye, a couple others I'm missing. And, you know, there was nothing really bad happened. We didn't even have much of a market correction. And those stocks dropped 35 to 50% to an A. Some maybe more than 50%. I'm pretty sure all of them dropped at least 35%. I think the average drop. Now I had a spreadsheet on that group at one time. I think the average drop was about 45% off the highs. That was the 2014 highs. Again, that's quite a few years ago. And but what happened around that time? Same thing. Kind of had a hot market. Well, people were chasing the small number of hot names. But you had Alibaba came out. And it was the same thing. You had some smaller deals come out, trade okay, but you know, stuff started kind of maybe highs. The favorites had a hard time making higher highs. Charts started looking extended, started rolling over, but they kind of held on. I mean, the expression I use, a lot of charts look like they're hanging on by their fingernails, and then all of a sudden Alibaba came out. And I don't even know, you tell me what size. I think that was at least a $60 billion deal, something like that. And you know what? A lot of people just need a lot of money to buy Alibaba. And a lot of stuff got sold. That everybody was very content staying in because, oh, man, it's still so good. Staying in this stock that's so high, never goes down, just keeps making new highs. Boom, bottom dropped out of all that stuff. So a lot of money went into Alibaba. By the way, that's not like it did great. That stock didn't trade well for a while. But, you know, a lot of people got hammered, and at least people that sold high stocks and bought Alibaba kind of preserved a lot more value. So anyway, a lot of stuff happened around it. You know, you had a huge, by the way, 3D printing stocks were super hot in the spring of 2014. They got absolutely shemized. So, you know, again, kind of similar setup today. I don't know if Lyft does it. I don't know if Lyft is big enough to kind of knock a bunch of stocks off the pedestals. But I think the combination of Lyft, Pinterest, Uber, Palantir, and we don't know when Palantir is coming, but I think the bulk of those names, and some of those names are pretty attractive. I mean, I think Pinterest is going to see very good trading activity. And I think Pinterest is going to be the opposite of Snap. Snap was like the ultimate long Twitter, short Snap at IPO trade. It was like the greatest pair trade in the world. Twitter could go up on the Pinterest deal too. That could be another thing that ends up helping Twitter, because Twitter's valuation will be highlighted as cheap relative to Pinterest most likely. But that said, again, unless they jam Pinterest so high and so expensive, I think Pinterest will be one of the better deals to come out. So anyway, we'll see. We'll see how Lyft is. We'll see how it trades. I think it's going to surge. I think it's going to go up a lot. I'm almost scared about how much they jam it versus the IPO price, how much it opens. If it opens somewhat benign, I might play it. I mean, I love trading IPOs. I really do. I have to see where it comes out. But I think, you know, this deal is going to be a big deal. People are going to need money for it. I mean, one thing I know I would do if I had an IPO allocation. So if I could get Lyft at pre-IPO pricing, I would do it. And I would sell stock to participate in the Lyft pre-IPO. And again, I think that's going to start happening. If it hasn't started happening a tiny little bit already, again, people don't need to do it. They can sell stock, you know, the day before, right? Maybe the day of the deal. But you know, there's going to be plenty of people who get Lyft pre-IPO and then want to buy more Lyft. So we'll just have to see how it trades. I do think Lyft is going to be very interesting, though. The biggest thing, and I'm not trying to be overly anticipatory. It's possible the market keeps going up post Lyft, but that, to me, that's going to tell me something. So in other words, whatever the market does for the next 4 to 5 trading days after Lyft is out and trading is going to tell me a lot of information, and we don't know what's going to happen yet. But it feels a lot like spring of 2014 to me. It really does. And again, similar kind of setup. You had multiple IPOs coming. You had a fair number of smaller growth deals. But the thing that really kind of put an interim top in the market was the Alibaba IPO. A lot of people like to go back at a time and say, well, wait, Janet Yellen sort of ushered irrational exuberance. I don't really think that moved the market very much. I think it was much more the kind of the cascade of IPO supply that came into the market ended up really hurting the current winners of the day.
All right, so just for your own sake, we had something posted here that Lyft likely to price IPO above the $62 to $68 range. This comes from the WSJ. I don't know where that falls in line with what you were thinking.
That sounds consistent, but I don't know if that tells us that much because, one, they probably might raise that price a little bit. Two, again, doesn't tell us anything about what the first trade is going to go off at.
Sure.
so I mean, if the price is 68 and goes off, I mean, here's the problem: if it goes off at 72, people are going to freak out, right? Because they're like, oh my God, why is it not up more? This is a delicate dance. This is a delicate dance. And they want the thing to look good, but do they price it so high and so hot that it's hard to buy? We'll see. I don't know. I mean, I was shocked. I mean, I think Elastic was I think the IPO price at 36. I think first trade was like 66 or something like that. I actually thought they might make that somewhat more palatable. Like maybe maybe 45, 50 to kind of let people into it. But they didn't. That thing jammed up. That thing priced, again, it was at least 85 to 100% above the IPO price. So people can feel free to check. I'm pretty sure I haven't looked at this for months, but I'm pretty sure Elastic priced at 36, and I think first trade was in the 60s. So if it wasn't 100%, it was pretty close. If Lyft does the same thing, I'm just like, okay, I'll let other people mess around with their money on it. I'm not going to mess with it. If it's 85, 100% higher than the than the IPO price, then I'm not going to do anything on it.
All right. Well, you will keep us posted if you do anything. Is that correct?
Yeah, sure.
All right. Well, that sounds good. All right, Tech T, that's all I have for you for today. I apologize. It sounded like our connection was a little choppy. Not sure if it was your end or mine, but
I don't know. I had a hard time getting my Sky or my Bluetooth going, but then everything sounded clear to me on my end.
Okay. Well, hopefully it did as well to the listeners out there. As always, Tech T, thank you for joining us today, and we will touch base next week.
All right, take care.
All right, thanks a lot.